Okay, the recording has started. So today we're going to cover chapter 9, which chapter 9 is about budgeting. It's a very interesting chapter, again, another one. So please pay attention and everything will be fine. I'm going to start sharing my screen and we're going to go one after another. First, we're going to start with the PowerPoints and then I'm going to move to the Excel spreadsheet with combination with PowerPoint and Excel spreadsheet. And at the end, I'm going to post you the recording from today and the Excel spreadsheet that we're going to develop today. Okay, let's start first with the slides. Share my screen with you, and now you should see the slides. So budgeting. What's interesting about budgeting and what budgeting is? Budget. To some extent, all of you already know what budget is, and to some extent, probably most of you already done some budget. But let's see from a purely theoretical point of view what a budget is. Budget is detailed quantitative plan for getting and using resources. That's something that I want you to think about it. So first we have to get something in order to use it. That's why we have plan, which is quantitative plan. So now that can be financial resources and can be any other resources. That's the interesting part. It doesn't have to be always about money. I know most of the budget that people prepare these days is about money coming in, money going out. But it doesn't have to be. That's why people, when they go to the grocery store, they have a list. That list is technically their budget. They already have a detailed plan of the quantity of resources that they're gonna purchase from the store in order to use it later in their life. So as you can see, budget is again detailed quantitative plan for getting and using resources, financial and any other, for specified up forthcoming period. The whole process of preparing that budget is called budgeting, and when in organization, in the company or the government level, depends where you are, when you prepare the budget, you can use the budgetary control, which is activity in the organization that closely look at all the resources which are acquiring and all the resources which are used. Budget obviously is part of the planning stage of managerial accounting. If you remember very first chapter that we took, we're talking about the management and the managers and the different activity that managers has to follow, different steps in the management. One of the activity was planning. So planning is one of the activity which is involved in budgeting, and the budgeting we're doing in the planning activity, which involved developing objectives and preparing various budgets. So once you have one objective, you can achieve that objective different ways. Every way that you're trying to achieve that objective, you can prepare different budgets. Now, which way you're going to choose, that's a different story. So once you choose the way that you want to achieve that objective, then you can prepare the various budgets. Control is one of the steps of the management account, which involves steps which has to be taken by you. Don't forget, you're the one who is the manager. And why do you need control? Just to make sure that you follow the budget in order to achieve your objective. Again, control is not a bad thing. Control is actually a good thing because make sure that you follow the steps that you outline in the planning stage and the stage of preparing your budget in order you to achieve your objectives. So which advantages if we have the budget? First advantage is obviously to define the goal and objectives. That budget is going to help you to clearly see where you're going to go and what's the objectives that you want to achieve. Second thing is you're going to coordinate all the activities which are needed for you to achieve your goal. Then you're going to see the allocation and all the means of allocation of the resources. Again, the whole point is you to achieve your goal and objective. Budget is going to help you to uncover potential problems or bottlenecks. We're going to talk about bottlenecks again later when we start talking about the decision making. He's going to help you to think about what can you achieve in the future. So it's going to, once you prepare the budget, you're thinking about forward, what's going to happen tomorrow, what's going to happen the day after tomorrow. So you're thinking about the future. And the last thing is going to help you to communicate the plan with the people who can see the budget. Who's going to be held responsible for the items and for which item is going to be held responsible for? Usually managers has to be held responsible, but they have to be held responsible only for the items that they can actually control. For the items that people cannot control, you not keep them responsible. How can we prepare the budget? And what kind of budget we can have? Based on the objectives and based on the goals, we can have operating budget and we can have a capital budget. Operating budget is the one that covers 12 months or next operating cycle of the company. It says cover 12 months of operating cycle, whichever is longer of the company. That's why it's called operating budget. If the budget is more than 1 year or operating cycle of the company, it's called capital budget. I'm not gonna waste your time with the capital budget in this course. I'm gonna leave that one to financial accountants, for people who want to teach you finance. Or in the finance, you're going to talk more about the capital budget and how to do the calculations, because once the period becomes more than 12 months, we have the effect of the time value of the money. And for the time value of the money, that's a little bit more complicated situations. So those people who teach you finance, they should explain to you better. Now, once we have that annual operating budget, we can divide it into months. We can divide it by quarters, or we can divide it half, like 6 months and next 6 months. As you can see today, we're going to start preparing monthly and quarterly budgets. The other thing, the other classification of the budget that you can see is that budget can be continuous or can be zero budget. What's the difference? The continuous budget is every time you're running 12 months. Every time when you prepare the budget, you have the 12 months. And what that means that once month expires in one side of the budget, you add it at the end of the budget. For example, you're starting first budget that you're going to prepare from January to December. At the end of the January, once the January expires, you're going to add January at the end of the budget. So you're going to run now from February 1st to January 31st. When month of February expires, at February 28th or 29th this year, you're going to add February at the end, and then you're going to run March 1st to February 29th. And that's how you're going to have that continuous 12-month budget. Now, next thing that we have to cover is how we're going to prepare that budget. Okay, two ways to prepare the budget. We're going to talk not next time, the following time, about the company structure and company organization. But before we do that, let's think about it, how we can prepare the budget. One way to prepare budget is person from the top managers, give it the budget to the lower management, and the lower management has no options to choose what they have to do and how they can do it. The other option is to make those people work, means that ask them what they want, starting from the bottom, from the supervisors, go to the middle management, and combine everything in the top management. That that way of preparing the budget is called participating budget. Because all, let's say, company staff on all level is involved in preparation of the budget. Obviously, there'll be advantages of doing that, and the advantages is the everybody in the organization it's viewed as a team member, which increase their motivation. Budget estimates, which are prepared on that way, are more accurate because the lower management know what they want. If the top manager tell them what they think they want, that may not be accurate. Again, increase the motivation. More you get people engaged in the process, they feel more motivated and more appreciated. And the last thing is that people, since you're asking for the budget, later on they cannot come and complain that the budget was not realistic because actually the numbers come from that. So participating budget have one problem, which is called budgetary slack. What that means imagine this: you as a salesperson, your bonus is based on sales. Your manager comes to you and asks you for the next year. Let's say it's a car dealership, you're selling cars. You're sales manager. And your boss coming and asks you, how many cars you planning to sell next year? And you know that your Christmas bonus, is based on achieving the budget and going over the budget. So you're doing simple calculation. In the worst year, I can sell 50 cars per year. In the best year, I can sell 70 cars per year. So in that case, I'm going to give my manager a number which is easily achievable by me and which give me opportunity to sell, to achieve it and go over that number in order to get my bonus. So I can easily lower that number. I can say, okay, next year I plan to sell 50 cars. And by the end of the year, selling 70. And at the end of the year, going to your manager and say, see, I told you I can sell 50 cars, but I actually sold 70. Now give me the bonus for the 20 cars over the budget that I sold. That's called budgetary slack. Why? Because the lower level of management, they perfectly know what they can achieve and how they can achieve it. For that reason, top managers have to do their due diligence and to initiate that process to oversee the budget that is prepared by the lower management. For that reason, not only for that reason, but for all other reasons, we may have that budget committee. Budget committee is in the big organizations which actually involved in preparation of the budget. What the budget committee is responsible for? First, they're responsible for the overall policy related to the budget, means how we can achieve what we want. That's why the most important thing is you to figure out what you want for the company. That's why it's very important people to clearly state their objectives and their goals. Then we can prepare the policy which through the budget will bring you to your goal or to you to achieve your objectives. Also, the budget committee is going to be involved in coordinating the entire preparation of the budget. They're going to decide is it going to be participative budget or is it going to be just given by the higher top managers to the low managers. The other thing that's important for the budget committee is to resolve any disputes which are related to the budget. While the lower management gives you or implement that budgetary slack in the budget, the budget committee will be the one that's going to say, hey, that's not realistic, you have to come up with a better. And the last thing is the budget committee will approve the final budget. Which are the factors that makes one budget successful? First one is the top manager must be enthusiastic and committed to the whole budget process. Also, top manager should not use the budget to punish or blame the employee when something goes wrong. And the other thing is the top manager, in order for the budget to be successful, the top managers has to put the numbers in the budget which are high but achievable. So, targets which are achievable are preferred better than the target which are too high. In other words, is if you see a student which is generally going at the level C plus, giving to that person target to go from C plus to A plus, that's not realistic. And that you know that that's not realistic. The person knows that's not realistic. So technically, instead of motivate the person to achieve at A plus, when you demotivate it, and he's going to next semester he's going to go C minus. So what you have to do is you have to implement in the budget targets which are easily achievable. So from C plus, bring the person to first to B minus or B, then bring it to A minus, and then we can talk about B plus. But that's going to take time. Zero budget, I mentioned before, the zero budget. Zero budget is the one that every year starts from zero. So technically, whatever happened last year, we just disregard it, start from zero. Most of the management complain that this is too heavy and too time consuming. So we better work on the numbers from the previous year, update to the current situation, and we have to update for the inflation or the new factors that's coming in the business. Well, so, how are we going to do the budget? One thing that I want you to understand: the budget again is a plan, detailed plan of how we're going to get and how we're going to use the resources. For that reason, we started all the budget process with getting available resources. How can we get the resources? By selling. The only option that you have when you start your business to get resources is to sell. You can do activities, you can buy items, you can do whatever you want, but the only way you can get something back is to sell. For that reason, you always start with the sales budget. Once you get the sales budget, then you can come up with the inventory budget, which gives you the numbers of the sales that you need to achieve. Once you get that inventory, it's going to help you to achieve the sales that you plan to achieve. Then you start preparation of the production budget. Now, talking here about manufacturing company. And since we already know that product costs are direct material, direct labor, manufacturing overhead, we have to prepare separate budget for direct material, direct labor, and manufacturing overhead. Those are our product costs. Now we already know that the product cost goes on the balance sheet, but we have other expenses, which are selling administrative expenses, which go directly to the income statement, which means their period cost. So we have to prepare a budget for those selling administrative expenses, which is our period cost. Once we get the product and period cost, we can prepare now the cash budget. Once we prepare the cash budget, we can easily prepare income statement budget and balance sheet budget. So what we have to do today, start one after another and start preparing budgets and go to the whole process of the budget preparation. So let's start and see how it goes. First, let's have some data. This company is preparing budget for the quarter which ended on June 3rd. The anticipated budget for the next 5 months: April 20,000 units, May 50,000 units, June 30,000 units, July 25,000 units, and August 15,000 units. The selling price per unit is $10. So first thing what we have to prepare is the sales budget. How are we going to do that? Very simple. Now we're going to start flipping back and forth between the PowerPoints and Excel spreadsheet. What I want you to do is, if I forget to share the Excel spreadsheet, please catch me right away, so we can stay together on the Excel spreadsheet and the PowerPoints when it will be for monitor. So first thing I have to share is my Excel spreadsheet. So let's share that one. Can you guys see the screen?
No, Professor.
No.
No? Let me
No.
try again. Oh, I don't see it either. Let me see if now we can see my PowerPoint. Let's see now if I can share my Excel spreadsheet. Still nothing, yeah?
Yeah, no.
All right, let's change. Can we do this? Let me try again. For some reason, it doesn't let me share my Excel spreadsheet. Interesting. I can share the PowerPoints, but I cannot share the Excel spreadsheet. Okay, what I'm gonna do is I'm gonna post you in. No, actually, I'm not gonna post you. I'm gonna send you email with the Excel spreadsheet, and we can start. And we're gonna start working together on that template. Just give me a second, and I'm gonna share it with you, and we can start working. Can you please check your emails in Moodle and see if you have received a file from me?
Yes, we did.
Okay, awesome. Let's work with that file. Let's
Receive.
see if we can. Okay, so I can share my Word document. For some reason, I cannot share my Excel spreadsheet. Let me try to open my Excel spreadsheet again on the separate. Let me save it first. Open it and see if I can work with that sheet. How about now? Can you see it?
Yes, we can.
Awesome. So
Yes,
that's
Prof.
exactly the same Excel spreadsheet that we have, correct? So what we have to do, we have to prepare budget for the quarter that's ending June 30th. Let's think about it. Each quarter starts from first of some month and end up at the end of the day of the other month. So let's figure out if the year has 12 months, we're going to have technically 4 quarters, correct? So the first quarter will be from January 1st to March 31st. Second quarter will be from April 1st to June 30th. The third quarter will be from July 1st to September 30th. And the last quarter will be October 1st to December 31st. Make sense?
Yes.
So, since we have to prepare budget for the quarter that ends on June 30th, which will be the starting month for that quarter. Obviously, that will be the second quarter, and the starting month will be April. To be specific, that will be April 1st. So, do I know my sales for April? Yes, I know. I'm supposed to. My plan is to sell 20,000 units. In May, I'm planning to sell 50,000 units. In June, I'm planning to sell 30,000 units. In total, for the second quarter, which ends June 30th, my plan is to sell 100,000 units. Going forward, in July, I'm planning to sell 25, and in August, I'm planning to sell only 50. My selling price is $10 per unit. $10 here, $10 in May per unit, $10 per unit in June. So average price $10 for the whole quarter, $10 for July, and $10 for August. So if I sell those 100,000 units in April, May, June, I'm supposed to make 100,000 units. And if I charge my clients $10 per unit, my sales will be $1 million. Make sense?
Yes.
That's very straightforward, nothing hidden here. As you can see, that's nothing scary, nothing enormously complicated. Number of units, sales price per unit, total sales. 1 month, second month, third month, quarter, get the sales. Let's go now to slides and see what the slide's gonna offer us as a solution, which will be exactly the same. Nothing more, nothing less. The slide's gonna show us that once we prepare that budget for the second quarter, the quarter is gonna start from April, it's gonna include May, it's gonna end up in June 30th. For April, we're gonna have 20,000, May 50, June 30, total 100,000 units, $10 sales price per unit. We expect to have sales for the second quarter, $1 million. Now the question is sales equal to the money that we receive? Well, on some businesses, that's exactly what that means. But in order that to happen, we have to run cash business. In that case, whatever we sell, it's converted to cash right away. In this scenario, that's not the case. In this scenario, we have collection. We have sales on account. Means that we're having some cash sales, but the rest on account. So how are we collecting our sales? 70% of our sales we're collecting in the month we sell. The other 25% we're collecting in the month following the sale. That comes to 95%. 5% of our sales we never collect. Those are just gone. So what that means? That means that 5% of our clients never pay. The other information that we have is on March 31st, we have accounts receivables which will be collected, all of them, for 30,000. So now what we have to do, we have to prepare our collection budget. How are we going to do that? I'm going to stop sharing this. Second, I'm going to move to this spreadsheet that you already have. So you can work with me and we can start preparing that sales collection budget. what we have to do, we have to scroll down a little bit. We're going to see all the information about the collection that we have, and we're going to start collecting. So first thing that we're going to collect in April will be the $30,000. So we're going to collect this $30,000, which is our accounts receivable ending balance of March 31st. Then, in April, we're going to collect 70% of the sales, which is in April. So 70% of $200,000 will be collected in April. The other 25% of April sales, we're going to collect them in May. So total of the sales from the $200,000, we're going to collect 95%. That's going to give us $190,000. 5% of 200,000, which is equal to $10,000, we never going to collect. Now, same what's going to happen in May now. In May, we're going to collect the 25% from April, plus we're going to collect 70% of sales in May. How much is our sales in May? 500,000. 500,000. So $350,000 we're going to collect in May. When we collect the other 25 in June, how much will be that? That will be exactly $125,000. So out of $500,000 sales in May, we're going to collect only $475,000. 5%, which is $25,000, we never going to collect. Now in June, we already said we're going to collect the 25% of May sales. And we're going to collect 75% of June sales, which is $200,000. So we're going to collect $225,000. And that will be our collection for the quarter. How about the 25% of the June sales? Well, those one we're going to collect in July. So, of 25, the last 25, the 25% from June sales, we're going to collect it in July, which is the next quarter. So, in this case, how much will be our accounts receivables at the end of June, June 30th? Our accounts receivables will be $75,000. $75,000, we're going to use this number when we start preparing the budget, the balance sheet budget for this month. That will be our accounts receivable. So as you can see, our sales are 1 million. But from those 1 million, we're collecting only 890. We're collecting $30,000 from the sales previous quarter, and we're leaving $75,000 in the next quarter. So with 1 million sales, in this quarter we're collecting only $950,000. So at this point we have our sales in our collection. Now we can start working on the other budget. What will be the other project? Let's go back to slides and find out what is the next thing that we have to do. So let's see here. First thing that we're going to collect in April is the outstanding accounts, balance accounts receivables from March. Next thing that we're going to collect will be 70% of the sales from April. In May, we're going to collect 25% of the sales in May. From April plus 70% of sales in May. In June, we're going to collect 25% of the sales in May plus 70% of the sales in June. The question is, what will be our total cash collection for the quarter? Somehow we get different numbers, but let's double check the numbers. Why our number is different than those numbers. 920, we don't have that number, sir. As an answer, do we? Oh, how much will be the collection, the total collection for the quarter? The total collection 905. Why is 905? Why is it not matching that number? Let's double check our calculation and see where we make a mistake. Yes, I know where I'm making a mistake. So I mistakenly, I hope you didn't make that mistake. Share my screen or share my mistake. In the month of June, instead of 70%, I plug here 75%. If I put here over 70%, then I'm going to get the 905 number, and that will be the correct number for our collection for the second quarter. So as you can see, the things are even worse. From $1 million sales, we collected $905,000 cash. Now we can clearly say which is the correct answer. So what we have to learn from this is please don't make my mistakes. Make sure you plug in the right numbers. So our total collection, $805,000. So what that means, we already prepared the sales budget and expected cash collection budget. Congratulations, the first two budgets are prepared. Now, next thing, what we have to do is we have to make sure that we have production which matching our sales. Because it will be awkward with planning to sell 20,000 units in April, but we do not have production. Those were produced. So for that reason, now we start working on the production budget. Production budget. What's interesting with the production budget? First, management of the company wants the ending inventory at the end of the month to be 20% of the following month budget sales in units. Why is that? Well, let's think about it. Is it good for you if you're running your coffee shop and sell all your inventory at the end of the day? Obviously, it's good because you're going to increase your sales. But at the same time, it's not good because the next day you can start selling the coffee. Why? Because you don't have coffee. So if the first customer comes at 6 o'clock, what you're going to tell the customer? Sorry, I'm out of coffee. I sold all my coffee yesterday. Yay! But today I don't have coffee. Can you come at 10 o'clock once I buy coffee? Because Costco opens at 9, so I can go grab coffee, drink here the coffee. Can you come at 10 o'clock so I can sell you some coffee? Can we do that? Obviously not. We're not going to be a real kind of business. So for that reason, always keep any inventory at the end of the period. Is it going to be a day? Is it going to be a week? Is it going to be a month? You always have to have any inventory. Since the shortest reporting period for the accounting purposes is a month. Always make sure you have ending inventory at the end of the month. So once we have this information, we have our sales. Let's start preparing the budget for our production. How much we need to produce in order to have enough units to achieve our sales. What we have to do is I have to share an Excel spreadsheet. And you just have to follow me and see how we're going to do things. What we're going to do is we're going to go to the next worksheet with sales production, and we're going to click on that one, and we're going to start seeing the information. What we're going to see first, information that we just saw with the management wants ending inventory to be equal to 20% of the following month budget sales in units. Do I know my sales? Yes, we know our sales. From where we go again? From our sales. Yeah. Those are our projected sales. We can easily place it here as a. Okay. So once we have this, my budget sales in April, so 20,000. In May, 50,000. In June, 30,000. For the quarter, I expect to sell 100,000. July, I expected to sell 25,000. And in August, I expected to sell 15,000. Now, the question is, let me delete those one, and I can start working with those one. The question is, those are my sales. This is how much I expect to sell. But management wants me to have 20% at the end of the month, at the end of the April. I need to have also not only the units that I'm selling, but also I need to have the 20% of my sales next month, which is May. Or the 20% in the next month, $50,000 or 50,000 units. So I need to have 20% of those 50,000 units available at the end of the April, so I can start selling in May until my production for May starts to come. So what do I have to do? I have to just calculate. So I need to have 20%. So we're going to log this one for time 50,000. So I need to have 10,000. So in total, for April, I need 30,000 units. But hold on a second. I already have 4,000 from March 31st, which is my beginning inventory balance at April 1st. So I already have 4,000. So how many I need to produce at the end of for the month of April? I need to produce 26,000 units. How about May? May I need to sell 50. But I also need to have at the end of May 20% of the sales in June. So I need to have here 6,000 units. In total, I need to have 56. I need to produce 56. That's how many. Sorry, I need to have 56 available. But hold on a second. I already have at the end of April. Remember, at the end of April, we keep in 20% for the sales of May. So we have those 10,000 already. So we need to produce only 46,000. In June, we're going to do the same thing. First, we need to have 30,000 for our sales. Plus, we need to have 20% from our sales in July. So that will be equal to 20% from our sales in July. So I need to have 5,000. So in totals, I need 35,000. But hold on a second, I already have 6,000. So my production needs to be 29,000. Now in July, what's going to happen in July? I need to have 25,000. Plus I need to carry 20%. I need to carry 20% from my sales in August. Oh, that means 3,000. I need to have 3,000 available at the end of July. So in total, I need 28. But hold on a second, I already have from the end of June 5,000 units. So in July, I need to produce 23,000. And if we have the information for September, October, if going forward, we can easily prepare continuation of this. Now, our focus, however, is on the second quarter. So what's happening in the second quarter? Our budget sales are, we budget to sell 100,000. At the end of the quarter, which is end of June, we want to have 20% of the next month's sales, which is exactly 5,000. So the ending balance for June become ending balance for the quarter. So in order to get our sales and have 20% of the July's sales, we need to have 105,000 units. But we already have from beginning of the quarter or from April 1st, we already have 4,000 units. So what that means? That means in this quarter, we need to produce 101,000 units. So as you can see, if we want to sell 100,000 units, we need to produce 101,000 units. That way, in only that way, we're going to have, we can achieve our sales, have 20% of the sales in the first month in the third quarter. And we're going to have a smooth sales and no problem with sales. Now we have our production budget. Now let's go back to the slides and see how the slides continue at this point. So the slides start the same. We have the months, we have those sales. We're planning to sell 100,000 units for the second. Then we're going to add the desired ending inventory, which is 20% of the next month's sales. We're going to calculate the total that we need. We're going to deduct the beginning balance from the previous month. In the beginning of the April, that will be ending balance of the previous quarter. And we're going to get our production for the current month. We're going to apply the same logic for May. And here the question is, what is the required production for May? That question we can easily go and check our Excel spreadsheet and see the answers. So for May, our required production is 46,000. So that will be answer. B. In our case, that will be should be the correct answer. Let's see, that's the correct answer. So what we're going to do for May, we're going to start the sales, which is 50,000. We're going to add the ending balance, which is 20% of the sales of the next month, which is 6,000. In total, we need 56, but we already have 10,000. So we need to produce 46,000. And we're gonna keep going until we prepare the quarter production budget for the quarter. Again, for the quarter, we're gonna calculate budget sales. April plus May plus June. 100,000. For the end of the quarter, is our ending inventory will be the ending inventory of the last month of the quarter, which is June. Then we're gonna get the total needed. Then we're gonna deduct the beginning balance at the beginning month of the quarter, which is 4,000 units. And we're gonna get our production, which is 100,000 units. So now, once we have our production budget, our life is a little easier. Why? Because now we have to move to the three costs which are related to our production. Means direct material, direct labor, manufacturing. Let's start with direct material. Direct material, since it's material, and since we don't want to run out of material at the end of the month, we're going to put some requirements. First thing first though, in order to produce 1 unit of our production, we need 5 pounds direct material. Management doesn't want to run out of material. For that reason, they want 10% of the next month production required for that material for that production to be available. On March 31st, we have some materials which is $13,000 pounds, and the cost for the material is 40 cents per pound. So what we have to do now? Start preparation of the direct material budget. How are we going to do that? Very simple. I'm going to stop sharing first. I'm going to Excel spreadsheet, and I'm going to show you. For direct material, we're going to move to the next worksheet, which is DM or direct material. Now, on DM, we're going to start with our production budget, which was right here. I'm just going to copy those one, and I'm going to paste it. So I get those numbers. The last thing that I did is to get July and August. I'm going to put July, August. And I'm getting some. What I'm missing is these are ending inventory at the end of June, which is 20% of sales in July. It's 5,000. These are ending inventory at the end of the quarter will be the inventory at the end of the month of the quarter, which is June. Beginning balance, my beginning balance was 4,000 units. And that was my beginning balance of the quarter, which is 4,000 again. So now I'm the same reality of the production. In order to sell 100,000, I need to produce 101,000. Now I have my production. This is my starting point for the direct material. So for my production, I'm going to get those numbers. April, May, June, 101. And I'm going to get even July, which is 20,000. What I need 5 pounds per unit. 5 pounds. pounds here, 5 pounds here, 5 pounds here, for the total 5 pounds, and for July 5. What that gives me, let me delete those ones so we can prepare it ourselves. That tells me that I need to, production that I did, that's not production, that will be the direct material. Let's change this one. That will be production material, that will be material needed in pounds is 130,000 pounds in April, 230,000 pounds in May, 145,000 pounds in June, and 550,000 pounds in July. This is the material that I need. But now the question is, we already know we have to keep inventory. And we already know that our inventory, beginning inventory for April 1st, which is the ending inventory of March 31st, is 13,000 pounds. I already have those 13,000. So in April, sorry, that's not the one that I'm looking for. I need 10. So first we have to add the desired ending inventory. That will be the desired ending inventory, which desired ending inventory is 10%. Let's add that one first before we deduct the beginning inventory. So desired ending inventory that we need to keep at the end of the April is 10% of material that we need to produce our production in May, which is 230,000 pounds. So 10% of that material we need to have it available at the end of April. So we can start May. So that will be 10% of this number, that will be 23,000. So we need to have 153,000 pounds of material. But hold on a second, we already have 30,000 pounds, which is available from the last quarter or from March 31st. And we have it at April 1st. So 13,000 that we already have is going to reduce. So what we need to do is to purchase in April 140,000 pounds. Once we can purchase 140,000 pounds material, we can produce 26,000 units because we want to sell 20,000 units in April. Now, next thing, we have to do the same thing for May. May, we need to produce 46,000 units, but we need 5 pounds material per unit. That we need 230,000 pounds. We also need to have 10% of the next month material that we need, or we need to have 14,500 pounds. In total, we need to have 244,500 pounds. However, we already have, from the end of April, we already have 23,000. So we need to ask our purchase manager to purchase. We're going to do exactly the same thing, but using the numbers from July. So in June, we need to have 145,000 plus we need 10% of the materials that we need in July. That's 11,500. But we already have 14,500. So we need to purchase 142,000 pounds. So if we have to prepare our purchase for the quarter, materials we need to achieve our production is 505,000. However, we need to have 10% of the next month materials available. So our desired ending inventory for the quarter will be the desired ending inventory of the month which the quarter ends, which will be June. That's 11,500 pounds. In total, we need 560,500 pounds. But we already have, in the beginning of the quarter, we already have 13,000. So, for the second quarter, we need to purchase 503,500 pounds of material in order to produce 101,000 products. Let's stop sharing this and let's go back to slides and catch up with the slides. Again, we're starting our production. We're adding the pounds per unit that we need for our production. We're getting the total pounds that we needed. We're gonna start adding now the ending inventory that we need for April, which is 10% of the material that we need for May. And we're gonna deduct the material that we already have from the March 31st or April 1st, which is 30,000. So the material that we need to purchase is 140,000 pounds. For May will be the question, how much we need to purchase in May. In order to do that, what we have to do, go back to the Excel spreadsheet and see what was the number that we get for May. And for May we have 221,500 pounds, and that will be our answer. So let's see if we get that answer correct. So our answer should be A. Oh, that's turned out to be correct answer. So if we follow the same logic, the ounce of material that we need to purchase in May is 221,500 pounds. If we do that, that's if we continue for June, we're going to prepare this calculation. Don't forget, for the quarter, production needed, calculate April plus May per June, get the total. Desired ending inventory is the desired ending inventory at the end of the month of the quarter, which is June. Beginning inventory is the beginning inventory at the first month of the quarter, which is April 1st. And then get the total material which are needed. Now the problem with the material is once we purchase it, we have to pay it. So this company found out that the material cost them 40 cents per pound. And they pay in the following pattern. 1/2 of the month of the purchase is paid in the month of the purchase. The other half is paid in the following month. At March 31st, we have accounts payable balance of 12,000, which will be paid in April. Now we have to prepare a budget for the payments, for the cash that we need for our purchases of direct material for the quarter. How are we going to do that? Very simple. We're going to move back to the Excel spreadsheet, and we're going to start with the Excel spreadsheet. So our pounds cost us 40 cents. We know how much material we have to purchase in April, May, June, and for the quarter. Now 40 cents is going to give us our money that we have to pay for the material. So let's start working. First, what we're going to pay in April. We're going to pay the balance from March 31st, which is $12,000 we're going to pay. No questions. Then what we're going to pay? We're going to pay 50% from the purchase in April, which is 28,000. The other 50% we're going to pay in May. Once we pay 28 in April and 28 in May, we're going to pay total 56. So we pay for the purchase in April. When we're going to pay the purchase in May? Well, 50% we're going to pay it in May. In the other 50%, we're going to pay it in June. In total, we're going to pay $88,600, which is exactly the cost of the material which we need for our production. What's going to happen in June? Obviously, in June, we're going to pay the 50% of May, plus we're going to pay the 50% from the purchase in June. 56,800, we're going to pay half of it. And what's going to happen with the other half? The other half is going to stay as accounts payable at the end of June, which is going to be paid in July. That's another crucial number that we're going to keep here, just in case, and we're going to use it later when we start preparing the balance sheet budget. So let's see now and go back to slides and catch up with the slides. Again, first thing that we're going to pay in April is the accounts payable for March, 12,000. Then we're going to start paying 50% of the sales in April. The other 50% we're going to pay it in May. What will be the total cash disbursements for the entire quarter? What we have to do is go back to the Excel spreadsheet and see where are our numbers. And as you can see, for the entire quarter, we're supposed to pay $185,000 for the materials, which we need to achieve our production, which guarantee our sales. So let's choose that one as answer and let's see what's going to happen. 185 is answer A. Which turned out to be the correct answer, and if we have to fill to see the whole calculation, we get exactly the same number. We're done with the record. Up to this point was the heaviest. Production budget and direct material as the most time-consuming budget. Why? Because we have to follow that logic with the ending balance that we want to have at the end of the month and the beginning balance that we have in the previous month. And here until the end is pretty much down here. So once we're done with the material, we need to prepare for the product, two more budgets for the product cost, which is direct labor, manufacturing. Let's start first with the direct labor. Direct labor is straightforward. What do we need? We need how much time we need to produce one unit. And we need 3 minutes for one product, which is turned out to be 0.03 hours. Now, the company pay has a no layoff policy, so all employees will be paid 40 hours for the work each week, regardless of how many hours. Minimum. That will be the minimum. They're going to be paid 40 hours per week. So what that means is if they work 35 hours, they're going to be paid 40 hours. If they work 37 hours, they're going to be paid 40 hours per week. If they work 20 hours per week, they're going to be paid 40 hours if they get paid more than 40 hours, so if they work more than 40 hours, then what's going to happen? Well, if that happens, they're going to get paid $10, which is the regular wage. But overtime, it's not going to pay. So then they're not going to get 1.5, they're going to get just $10, that's it. So if they work 50 hours, they're going to be paid 50 hours. $10 per hour. So it's kind of win-win. If they work less than 40 hours, they get paid 40 hours. If they work more than 40 hours, they're still going to be paid, but not all. So what that means is that the employer will be minimum hours they're supposed to pay. So for the next 3 months, the minimum hours the employer going to pay is 1,500 hours. Means that if the employee working less than that amount, they're going to pay them 1.5 thousand hours per month. Let's prepare our budget now. So what we need? We know that how many hours we need. We already have our production, and we know how much minimum hours the employee is going to get paid. And we have a rate per hour. What we need to do is move to the Excel spreadsheet and fill up the next worksheet that we have available for direct labor. What's our starting point? Again, our starting point is production. Let's get our numbers from the production, which are right here on the production budget. You can get those three numbers. Copy it, move to the direct labor, paste it as numbers, the values, and we get our production. The next thing that we need is enter the amount of time that we need to produce those units. And we're going to calculate that in April, in order to produce 26,000 units, we need 1,300 hours. In May, 2,300 hours. In June, 1,450 hours. But we have a floor, which means minimum hours that we need to pay, regardless of the hours that our employee work. Minimum hours 1,500. So in April, since they're working less than that amount, we're gonna pay them 1,500. In May, since they work more than, we're gonna pay them exactly how much they work. In June, again, they're working less than that amount, so we're gonna pay the minimum 1,000. So in total, we're gonna pay our employee $52,000. Let's go catch up now with the PowerPoint. We're getting our production. We need to produce 101,000 units. We already know it takes the employee 0.05 minutes to complete one unit. So the total hours that we need for April is 1,300, 2,300 for May, and 1,450 for June. Minimum the hours that we pay is 1,500. And since 1,500 per in April, that's how much we're going to pay them. 1,500 in April, times $10, 15,000. In May, we're going to pay, since they're more than 1,500, we're going to pay the exact hour work. In June, 1,450 is less than 1,500, so we're going to pay them 1,500. So in total, we're going to pay them 53,000. Now the question is, what will be the total direct labor cost for the quarter if the company follows no layoff policy, so they're still paying 1,500 hours minimum. But if they work more than that, they actually pay $15, which is overtime, for every hours which is worked than 1,500. How are we going to answer this question? Let's go back to the Excel spreadsheet and let's see what kind of help we have there. This is again our question. So, what we have to figure out first, get our production, calculate the production. That's our production. Hours per units, we already know it. Hours per unit is 0.05. And that's all across the board. And for the quarter, it's the same. So, what that means? In April, we're paying 1,300. 1,300 hours are the hours that the workers need to work, but we pay them 1,500. In total, we pay 15,000. Do we have an excess over 1,500? No, we don't. So we're paying only $10. In May, again, we pay them minimum 1,500, but they work more than that. So we have excess over 1,500, 800. Those 800, we're going to pay them $15. So let's pay them. That will be 100 times $15. And the last that left is for June. We pay the minimum 1,500. So that will be the total that we're going to pay. So in total, we have only 1 month that we exceeding 1,500, for which we owe them $15 per hour over 1,500. So in total, we need to pay $57,000, which is $4,000 more. So our answer will be D in this case. Let's go back to slides and check if that's the correct answer. Yes, that's turned out to be the correct answer. Again, we have only 1 month in which we exceeding the minimum payment of 1,500. And that excess will be 800. For those 800 hours, we have to pay them at $15, not at 10. So that $4,000 actually come with $5 extra that we pay for the 800 hours, which is 4,000. That concluding our direct labor budget. Now we can move to the manufacturing overhead. Manufacturing overhead, we need some information here. And the manufacturing overhead, they figured out that it's applied based on the direct labor hours. Variable manufacturing overhead is $20 per direct labor hour. And we have fixed manufacturing overhead of $50,000 per month, which including $20,000 non-cash item, which is depreciation of the plants. What we have to do now, prepare the manufacturing overhead. Let's get this information and go to the Excel spreadsheet and share the Excel spreadsheet and prepare the spreadsheet. This is the information that we have. Now what we have to do, we need to get the production. production, we're going to get it in the production budget. We already have it here. Those three ones. Going to get it, paste it right here. We have our production. Next thing that we need to do is to get actual hours that we spend per unit. And from the direct labor, we know that we're spending 0.05 hours. So we're gonna get 0.05 hours here. And we're gonna get the total direct labor hours that we need, not what we paid, what we need for our production. On those actual hours that we need for our production, we're gonna apply $20 fixed, variable overhead. Here and 20 here. And we're gonna get that the total variable overhead cost for the quarter is actually $101,000. Next that we have to do is to put the fixed manufacturing overhead, which is $50,000. The good thing with the fixed overhead is once it's fixed, it doesn't change from month to month. So in total, it's $150,000. So our total manufacturing overhead cost is $251,000. And our total hours are 5,050 hours. So from here, we can calculate our predetermined manufacturing overhead rate right here. Since we have the total manufacturing overhead cost for the period and the total allocation base, which in our case is the direct labor hours. And we can calculate that the predetermined overhead is $49.70. Now, if in order to receive the cash that we're paying for the manufacturing overhead, we need to deduct the portion of the non-cash item, which is depreciation. As you know, the depreciation is allocation of the cost of the asset to the expenses, which asset has already been paid. So the depreciation is not a cash item. We don't have to pay for depreciation. For that reason, we can easily eliminate those 20,000 on our cost in order to come up with the total cash that we need to pay for our manufacturing. So from the 250,000, 151,000 cost for the manufacturing overhead, we're gonna pay only 191,000. 60,000 is related to the depreciation, which is not cash. So once we have this, again we can calculate the predetermined manufacturing overhead, which is equal to the budgeted cost divided by the budgeted allocation base, which in that case is the direct labor hours. So our cost predetermined manufacturing overhead rate is $49.70. Let's go back now and catch up with the PowerPoint. PowerPoint, again, budgeted direct labor hours, which coming from the labor hours which are required. We're getting those direct labor hours. We're applying $20 for the variable overhead rate, and we're getting the variable overhead cost. The fixed overhead cost is fixed, so 50,000. And we're going to get the total manufacturing overhead cost. That will become a nominator for our predetermined manufacturing overhead. The allocation base of direct labor hours will become our denominator, So the cost for our predetermined manufacturer overhead rate is $49.70. Once we get this number, we can move to the next calculation, which will be the calculation of the ending finished goods inventory budget. Now, how can we do that? We can flip back to the Excel spreadsheet and work there. So, what do we know? We know that we need direct material, and we know that we need 5 pounds. We know that they need direct labor, and we need 0.05 hours. We know for 1 unit we need manufacturing overhead, which will be allocated based on direct labor hours, which is 0.05 hours. Our ending inventory. We already know from our production that our ending inventory at the quarter is the ending inventory for June, which is 5,000 units. Since we have all that information, what we have to plug is the cost. How much cost us pound, 1 pound? We already know 1 pound of material costs us 40 cents. That's not the right place, probably have to put it here. Cents. Yes. So we also know that direct labor, we're paying $10 per hour. And the last thing that we know that our predetermined manufacturing overhead rate is 49.70 cents. So our product cost for 1 unit is $4.99. And since we have 5,000 units, that gives us amount of total ending inventory will be of amount of $24,950. That will be our ending inventory, which we can use this number for the balance sheet budget. So let's see what the slide says at this point. Again, direct material, 5 pounds or 1 unit, cost of 40 cents, $2. Direct labor, 0.05 hours or 3 minutes, and $10.50. Manufacturing overhead, allocated based on the direct labor hours, 0.05 hours, and 49.70. Cost per unit. It cost us $4.99 to produce 1 unit of production. How many units we have available at the end of the quarter is 5,000. So our ending inventory balance is $24,950. Once we're done with this, we're done with the production. All the production budgets, direct material, direct labor, manufacturing overhead. Now we can start working with the period cost, which is sales administrative expenses. That's very straightforward, nothing scary here. First thing that we need is a little bit more information. Now the company, the selling administrative expenses are divided into variable and fixed. Variable selling administrative expenses are 50 cents per unit sold. Fixed, 70,000 per month. Now the total, the fixed selling administrative expenses on those 70,000, 10,000 are depreciation, which are not cash outflow. What we need to do is prepare the budget. I'm going to stop sharing this. I'm going to start sharing the Excel spreadsheet. On the Excel spreadsheet, we can go to the worksheet that says selling administrative expenses. Now what we need is the budget sales here. We need the budget sales. From where we're going to get it? all the way from the first worksheet, which is sales. So we're going to get those sales only for the quarter this time. And we're going to plug it here. Also remember our sales is 100,000. Now our salespeople, we're going to pay them 50 cents for every unit that they sell. In total, we're going to pay them $50,000 for the quarter. Also, we're going to spend $70,000 fixed cost. That's $70,000 here cost. And since it's fixed, every month will be 70,000. So in total, our period cost is $260,000. Out of those, 10,000 are not cash, not related to the cash out. So we're going to eliminate those 10,000, and we're going to get the total cash that we need to cover our period cost. So from the $260,000 period cost, we're going to pay only $230,000 cash. So the question is, how much cash we have to pay for the quarter? Let's see if that's actually the question on the PowerPoints. Yes, that's the question. So how much we need to pay is, I believe the number was, $230,000, which will be also, let's see if that's the right answer. And once we prepare, we're going to see that $260,000 is the expense, but the actual cash outflow is only $230,000 because we have $10,000 per month depreciation expense. And we're done with all those budgets. Now, the next thing that we have to do, probably one of the most important budgets, is cash budget. Now, for the cash budget, we need again more information. First, we're going to divide it by the 4 categories. We're going to have cash receipts or cash in. Then we're going to have cash out. Then we're going to see the calculation of what the difference between cash in and cash out. Are we going to have more cash or are we going to have less cash? Cash excess or cash deficiency? Once we figure out that one number, we're going to see if we have deficiency, how much we need to borrow, and if we have excess, how much we can invest. So we need more information. First information that we need is this company made a line of credit, $75,000, which line of credit they're paying 16% interest, annual interest. They need to have minimum cash of $30,000. So the cash cannot fall down than $30,000. For the calculation of interest, to make it easy, they borrow on the first day of the month and pay the loan back at the last day. So they're always going to have a full month for interest. Also, in April, they pay $49,000 dividend. Plus, in May, they want to purchase equipment for $143,700. And in June, they're going to purchase another equipment for $48,300. The last thing that left is the beginning balance for the cash on April 1st, which is $40,000. So we have this information. That what we have to do now, start preparing the cash flow budget. How can we do that? By moving to the Excel spreadsheet. The cash. So I'm going to start from the beginning and I'm going to show you how it's done. I'm going to delete everything. And I'm going to start like this. So, our beginning balance, as we already know, we need to maintain cash of our cash balance at April 1st was $40,000. Then what do we need? We need the collection, how much cash we're going to collect in April. From where we're going to see this? We're going to see it from the sales budget. We're going to go to sales budget. We're going to go down to the collection and we're going to see we collected in April $170,000. We get that. In total cash, we have cash of $210,000. Now let's see what do we have to pay. First, we have to pay for direct material. On direct material budget, we're going to see that we have to pay $140,000 cash. Sorry, actually it's $40,000. 140,000 pounds we need, but for that pounds we're paying only $40,000. For direct labor, we need to pay $15,000. For the manufacturing overhead, we need to pay $56,000. For the sales administrative expenses, we need to pay $70,000. Also, we need to pay dividend in April, $49,000. So in total, we need to pay $230,000. Now, since our cash outflow is more than our cash inflow, we're short $20,000. Not only that, don't forget we need to maintain $30,000 ending balance. Minimum cash that we need is $30,000. So how can we bring minus 20 to positive 30? By borrowing $50,000. Once I borrow $50,000, I'm going to convert minus 20 to plus 30, which is my objective to have $30,000. After I do April, I can start doing May. I'm going to start with $30,000 ending balance. Then I'm going to get my collection for May, which are $400,000. Can I do that? I'm just going to drag this formula here. What it does. Then I need to pay for direct material, direct labor, manufacturing overhead, sales administrative expenses. I'm going to drag those one. I'm going to put them here. So 72,300 for direct material. Direct labor, 23,000. Manufacturing overhead, 76. Sales administrative, 85. Total, I need to pay 256,300, but I'm not done yet. Why? Because I need to purchase equipment. For which equipment I have to pay 443,700. Once I do that, my total spending will be $400,000. Collection 430. Magically, we have $30,000, which is exactly the minimum balance. So in May, I don't need to borrow, but I cannot pay anything back to my borrowers. In June, we're going to start with the ending balance. June. Then we're going to add all the collection that we made in June, which is $335,000. Now, as you can see, is the cash that we're collecting for the quarter is exactly the cash that we have on our cash budget. Next thing what we're gonna do is we're gonna go over and we're gonna see how much direct material we pay. 72,700 in total. 185. 185. For direct labor, we're paying 53. We're paying 53. For the manufacturing overhead, we're paying 191. We're paying 191. For the sales administrative expenses, we're supposed to pay 230. 230. Now, last thing that left is to purchase this new equipment in June, which is $48,300, and that's left us with $95,000 excess. So the question that we're going to ask ourselves is, do we have enough cash to repay the borrowing that we took in April? Well, we have 95. If we pay 50, we're going to be with 45. So yes, we have enough cash. So let's pay that one. Let's pay the borrowing back to the bank. But the bank's going to charge us interest as well. Well, the interest is 16%, so that will be minus bracket 0.60 time. Let's go first and get the fraction. Divided by 12, because that's our annual. Divided by 12. And then that number time 3 months, we have it outstanding. 3 months. And that number time 50,000. That will be here time. So now we have to get the brackets correct. Be one bracket here, third bracket, and I believe that should be good. That's our interest that we have to pay for the 3 months at 16% annual interest on the 50,000. That's 2,000. And we end up with $43,000 cash. And our cash budget is done. Let's see what the slide says about this. So again, we're getting the beginning balance from April 1st, which is the ending balance in March. We're adding the cash collection. We're getting available cash. Then we're getting all the expenses. Direct material, direct labor, manufacturing overhead, sales administrative cash, plus the dividend. How much we spent? We are short 20,000. So we have to borrow 50 in order to cover the $20 shortage, plus we have $30,000 available. That's in April. May, we're doing exactly the same. June. Now the June is the question. How much excess deficiency cash we have over disbursement in June? That was 95,000. 95 is the correct. We're having the 95. With 95 we can repay back the borrowing, no more borrowings. Pay the interest, again 60% for the 3 months only, time 50,000, 32,000, and we're gonna end up with $43,000 cash. One advice for me: if you start your own business, if you're planning to start your own business, don't ever start it if you don't have this cash budget to see which month you're short, how much you need to borrow, how much you have to, when you can first repay your borrowings, when you're going to become a positive, when you're going to start generating cash. Don't start your business before you have this budget. So once we're done with the cash budget, the next thing that we have to do is the financial statement. First statement will be income statement. For the income statement, what we need, let's stop sharing this and move to the Excel spreadsheet. Show you how this will do it. For the income, net income, we have sales. From where we have the sales? In the sales budget. How much is our sales? 1 million. Why 1 million? Because we're selling 100,000 units. $10 per unit, 1 million. Our sales. Second, cost of goods sold. In the cost of goods sold budget, we know that 1 unit cost us $4.99. But we're selling 100,000 units. 499, 499,000. So that's going to give us gross margin at 5,100. Our operating expense, which is sales and distribution expenses, are 260,000. Not the cash expenses. 260. That's leave us with the income of $241,000. On the cash budget, we can see that we pay for the interest $2,000. So our net income is $239,000. And that's our income statement budget. Let's see what's the slides. $239,000. Again, this one comes from the sales budget, this one from the ending inventory of 100,000. That's sales and administrative expense budget. On the cash budget, we get the 2,000. We get it. Once we have our income, we can prepare the last budget left, which is the balance sheet budget. For the balance sheet, we need a little bit more information. And that which is given, we have the marked common shares, retained earnings, and equity. Let's see how we're going to use this information to prepare our balance sheet. Share the Excel spreadsheet, move to the balance sheet, and let me delete this one first and start collecting the information. Cash. Available cash, we're going to get it from the cash flow. And that will be equal to cash, we have $43,000 cash available. Accounts receivables, we're going to get it from the sales budget. Remember, we have $75,000 outstanding sales, which hasn't been collected, 75. Raw material inventory. Now, the raw material inventory, we have to figure out how much we got. From the raw material, direct material, we're going to find out that we have material need pounds 11,500, which cost us 40 cents per time. 40 cents per pound. So we have 4,600 raw material inventory. Finished goods inventory, we already calculated that number, cost of goods sold. Our finished good total ending inventory was 24,950. So we have current assets of 147,550. What else we have to add? We have to add the land, which is the 50,000. Then we have to add the equipment. The beginning balance is 175. But we purchase. How much we purchase on the cash budget? We see that we purchase 143,700 plus another 48,300. That gives us 367,000 equipment. Total assets are 564,500. So since we have that number, let's start to chasing the liabilities. Our accounts payable is equal to, once we go to direct material, we're going to see how much material we need to pay at the end of the quarter. That was 28,400 accounts payable. And that's all. Then we're going to have common shares. Common shares are given 200,000. Now retained earnings. How are we going to calculate the retained earnings at the end of the quarter? Now that will be the beginning retained earnings, which is 146,150 plus we're going to add the net income and we're going to deduct the dividend that we paid is $400,000 and we're going to get the retained earnings and then repeat it. Once we calculate everything, we're going to get total assets to be equal to the total liability. And that's how we prepare all the budgets from the beginning to the end. So let's wrap up everything in the PowerPoint. So our budget, again, cash from the cash budget, accounts receivables from the sales budget, raw materials from the direct material, finished goods from the cost of goods sold, land is given, equipment, beginning balance plus the two purchases of the equipment. Next thing is accounts payable, which is direct material purchases 50%. How much has I given? The last thing that we left is the retained earnings, which is the beginning balance, plus the net income from the income statement here, minus the dividend paid from the cash budget for mainly retained earnings. That's how we end up with total assets equal to the total liability. And we're done. We prepared the budget. Now the question is, what kind of budget we prepare? Tricky part is that we prepare a static budget. What that means, static budget? This budget is valid only and only at this level of activity. Only if we sell, let me show on the whole Excel spreadsheet. Only and only if our sales are those numbers, we're going to have this cash budget, we're going to end up with this cash, and we're going to have this income. If this number change, if only one number change, let's say for example, April sales moving to, we cannot sell 15,000, let's say 15,000 units, everything is going to change. Our cash not going to be anymore $43,000. Our income is not going to be the one that was before. Everything is going to change. Only 5,000 units in the first month if we change. So for that reason, let me share my screen again. The PowerPoint. Static budget. If we prepare only and only for planning and budgeting level, this budget is only good for planning purposes, not for the control. Because if anything goes wrong, we cannot compare anything. In order we to be able to compare actual versus budget, we have to come up with the flexible budget. What's the flexible budget? Flexible budget is we do prepare different budgets at a different level of sales, which ones follow different scenarios. Best case scenario, worst case scenario. For example, let's see this budget. This is a starting budget now. Starting budget is prepared for the 10,000 machine hours. If this machine is used 10,000 machine hours, that will be our costs. Now the question is, machine in reality was used for 8,000 hours. What are our variances? Obviously, we use the machine less hours. Because of that, our costs are less. So it looks like we have a favorable variances. But the question is, are those variances actually favorable? The only way to figure out that one is to adjust the first budget, starting budget, and prepare the very flexible budgets for different level of activities. So in order to do that, we have to remember how the variable and fixed cost behave. Means that total variable costs always change with the change of activity, while the fixed cost or total fixed cost remain the same. Variable cost per unit always stays the same. Once we have those, then we can easily calculate how much is our indirect labor here. If that's a variable cost and total cost is $40,000 for the 10,000 machine hours, that means our indirect labor cost is $44. Indirect material is only $3. Power is, looks like 40 cents. So once we have this, we can prepare actually 50 cents. Then we can prepare a flexible budget for different hours, knowing that variable cost per unit is $4 for the indirect, $3 for the material, and 50 cents for the power. And the fixed cost are fixed cost. And then we're going to apply different hours. And we're going to come up with the different numbers for the 8,000, 10,000, and for the 12,000. Once we have this, now once we compare, once we see the 10,000 were our budget, we can compare it with the 10,000 actual usage. Actual result was 8,000. Do we have flexible budget for 8,000? Yes, we do. So if we use the machine for 8,000 hours, we're supposed to spend $32,000 for the indirect labor. In reality, we're spending 34. Are we spending more or less? Obviously, we're spending more, 2,000. Is it favorable variance? No, it's not. Next thing, for the indirect material, we're supposed to spend $24,000. In reality, we're spending $24,500. Is that favorable? No. It's actually we're spending more, $1,500. So let's see the questions now. Here, we're supposed to spend $32,000, but we're spending 34. So, where is the variance for the indirect labor? 2007. 2007. Where is the indirect? 1,500. Where is the power? Well, power is the only favorable. And we spend overspending on the insurance cost. Now, once we have flexible budget, we can start analyzing of our spending and figure out why we're spending more or why we're spending less. And now we can start the control. But control, we're going to start working on the control next time. How the budget can be used for the non-for-profit organization, the same way that we explained today. Also, the government using the same process, preparation of the budget. So this process of preparation of budget can be used everywhere. The only thing that, don't forget, the only thing is that we're preparing a starting budget. In order to use the budget for control purposes, we still have to prepare a small budget at a different level. And that concludes today's lecture.